Okay, good morning. This is Axel Merk, President and Chief Investment Officer of Merck Investments, and I've been doing these daily updates. And I'm turning off my echo sound here. So about that. Um, since we've had more peak in uncertainty in the market, let's call it that. Okay, now it's working better. Good. So I've been giving market updates. Let me today give a little bit of an update on a discussion we just completed on uh, on the um, on the environment we're in, notably on the inflationary environment that we may or may not be in. Several people have pointed out that it will be very, very difficult not to have inflation in this environment, and uh, and others have pointed out that getting inflation is all but impossible in this environment. And so, which one is it now? Um, talking to so just looking at the monetary theory, you kind of have the perfect recipe. Somebody pointed out for inflation, you have a wartime type of um, supporting fiscal spending by monetary authority. You are directly printing money to enable a fiscal package. And so that is exactly what you do during wartime. Now, the scale is different. We are quote unquote only spending 10% plus of GDP at this stage, probably going to be 20% by the time this is done. That's just a wild guess. Maybe it's somewhere in between, maybe it's more. Historically, in wartime, 20% of GDP for government spending is kind of the baseline, and you can go up from there quite substantially. So, and also the US, of course, has deep pockets in some ways, at least for the short term. Other countries may not have deep pockets, and there may be broader fallout. But one of the things and then the argument against that is, of course, hey, there is no demand in certain things and so forth. Ultimately, we do not have a historic precedent for a virus hitting us like this. We had the Spanish flu, but the economy was very different at the time. It was also the end of the war. The word that there was a flu was also not not spread, so to speak, actively. There were efforts to suppress the news on that, and so that also obviously had a very different impact than what we're doing right now. But a few thoughts here on what's happening. When you do get inflation, it is not, as many people think, that everything goes up by 3, 4, 5% or higher, whatever the inflation is. What you get is a greater dispersion in the price of goods moving higher. And clearly, we've had inflation in the price of masks, of respirators, of other things, toilet paper, I suppose, as well. Eggs have been getting more expensive, I read, and whatnot. Whereas other items like cars that currently people don't buy, you're getting a great deal, you're getting discounts. Now, um, maybe it doesn't matter so much because eggs aren't as important as cars if it comes to GDP when the economy comes back up and running. The one thing, though, I do like to point out is that one of the things that happens when you have these sort of inflationary spurts that we're going to see in various pockets, there will be unintended consequences because the government is going to come in and try to quote unquote fix things. We have not had a rationing of toilet paper, luckily, but many of you heard the story that the New England Patriots sent the plane to China to pick up over 1 million masks, and some people were outraged that it wasn't the government taking care of it, that somebody had to send, that the owner of the Patriots had to send the plane. Um, Politics aside, it is in this case the free market that will allocate resources more efficiently. If you don't need the masses urgently, odds are you're not going to bid up the price as much. And so in the areas where you need them most urgently, you will be willing to pay a higher price. And with that, you will get the mass to these places more efficiently than if you had some government bureaucrat trying to allocate it. Now, obviously, we had a perfectly organized government on all levels and everything. Maybe one could minimize those inefficiencies, but this somewhat call it chaotic approach we're seeing is actually getting the job done. Now, I'm not arguing that not mistakes aren't being made and haven't been made, but we should embrace what we have to get the resources to the places. We cannot change the US healthcare system overnight. We cannot change procurement channels overnight. And so letting the free market play its role here has benefits. But fear not, government will, in some ways, interfere in things. They will say it is unfair that certain things happen in certain ways. And so with that, expect some disruptions. Now, what does that mean for financial markets? Because ultimately, of course, that's what we may be interested in. Does that mean certain assets will perform better than others? Well, obviously, if you make of mass in the short term, that may help you. In the long run, I think it's anybody's guess how this will play out. But with that, let me maybe shift focus here to the non-farm payroll report that we heard today, with over 700,000 new claims, as have been widely reported by now. The survey week is the week where you have the 12th of the month. That's how this report is done, which means this is a snapshot from the middle of the month. And rather than looking so much as the people have been unemployed, we can look at how many people are still employed. And amongst others, we have over 13 million still employed in the food and beverage service. And so we get a sense of, and obviously not everybody is going to be laid off in that segment, but we're getting a sense of the magnitude in this particular sector, for example, of the potential for additional job losses. Now, in these markets, we often look at the second derivative, the rate of change of things, right? We have the steep drop, and by all means, the next month's report is probably the big whammy, where we, in the early May, we will get the state of things of mid-April. And so that may well be the biggest rate of decline rate of decline might have been this month already from growth to negative 700,000. But I mention that because sometimes financial markets do find a bottom when the rate of change is ebbing off. As you may recall, at the beginning of the year, numbers were coming out of China, and not all of the numbers are necessarily credible to many people, but there were still trends visible in those things. And so the moment that Chinese curve was flattening, everybody, or not everybody, many people had a sigh of relief. Now, clearly, we have since moved on, and the rest of the globe is scrambling here. But let's not lose sight of the fact that as we try to flatten the curve here in other places, are we going to find a bottom? Now, the question I'm often asked, well, did we have this bottom recently in the markets? The reason why I am hesitant, and obviously I don't have a crystal ball, and I'm not giving investment advice yet, whatnot, and based on that, let me just put in here briefly in between the disclosure I have to show you. The fallout, the ripple effects, we just don't know yet. Historically, when we have a recession, it is contained. It is only one sector of the economy that is being affected. But then you have these ripple effects that other sectors are also affected. And so similarly now, you got these job losses because people get laid off. We give massive, unprecedented government support in many of these segments. But of course, these are consumers that are not going to be spending a lot right now because they're in emergency mode. And then not only that, if and when we will get the economy back open, but when we open the economy back up, it may happen in stages. It may happen slowly. Some people say about half the people will get their job back, and others will have to find new jobs. Whatever the number is, and I don't think anybody knows right now, it's not going to be everybody. It's not even going to be most people, because a lot of businesses will be out of business, and we've only seen the beginning of failures, of bankruptcies right now. And so the damage here that's going to be caused, the longer we do this, the longer it's going to hold on. And so that's also part of the reason why you have to focus on opening up the economy. The argument against that is obviously the right one. We have to make sure that we're not cascading into something worse if we open the economy. But that is why, in my view, you have to spend $1 trillion if you're going to spend this much money onto devising ways of doing this. And we do not need perfection in this. There are jerks out there that do not do social distancing. If you're one of them, stop it. But the point being here is if we get this reproductive factor to less than 1, the virus will fizzle out. We cannot get perfection. But we can do things. We can, if you commute to work with a car, that's less dangerous than if you use public transport. And so, in some regions, you can have other policies than in others. There's some headlines out today about personal tracking. I don't know how that's going to jive with privacy concerns in the US and Europe in particular. In Asia, that seems to be less of an issue. But there are things one can do. Obviously, testing can be ramped up, but we're not going to have an in-home 5-minute test deployed to all households that you can do every day before you go to work in the next week or two. It's just not going to happen. So that there will be setbacks, there will be delays in some of these things. At the same time, based here in California, where things appear to be getting under control, but our shelter at home mandate was extended till May 3. And the only nuances were really clarifications on people who thought that they could go back to work, that they shouldn't. What we need to start seeing is a relief on some areas where people can go. I do believe that people will listen to nuanced instructions. When I was walking outside yesterday afternoon, I would say more than half the people were wearing a mask for neighborhood walks. Several of them were, or most of them were older people, but the message got out that maybe now it's right that you should wear a mask. And so this message gets out very, very quickly. And again, perfection is here not the issue. The issue is that at some point there is some guidance on how to get things up and running. So anyway, back to the markets. It is Friday. That's always newsworthy in the sense that speculators are flattening the books. They don't know what's going to happen over the weekend, and so they don't want to take huge positions. One comment I want to make is on the oil market. Again, no investment advice here. And by the way, the reason I always look up is my Bloomberg is above my camera. My camera is one thing I didn't grab from the office, so I'm using a little notebook camera to do these interviews. But the crude oil prices I talk here is at 26.70. That's West Texas crude. We're hovering at $20 just a day or two ago, when President Trump tweeted that there might be a 10 million reduction in output. Let's keep in mind, and based on after him talking to the Saudis in particular, let's keep in mind, doesn't matter whether you love or hate the president, that a lot of what the president says is aspirational, which means that he is talking, he's engaged. That doesn't mean apparently there's an OPEC call on Monday or so. I might be off here by a day, but in any case, I wouldn't be surprised if there's a denial coming out somewhere. I wouldn't be surprised if there's not a 10 million reduction, that the number is going to be different or none at all. And so ultimately, that's going to induce more volatility in these markets. But the point is that, yes, this production war happening at the same time to maximize production is not sustainable. And with more policymakers, including the president, getting concerned and involved, we may be nearing the end of that. And so the facts really don't matter as much in any of these things. The market is forward-looking and realizes that things are happening and so forth, that there will be a resolution. Then, since a lot of the folks that follow me are interested in the price of gold, obviously the spot price right now is at 1620, having moved higher here a little bit, at least after the report. The gold tends to react to the potential policy response. Again, obviously the massive stimuli that we're getting as we're moving through this. And by the way, also China is announced to lower reserve ratios. That tends to be beneficial for the price of gold because the stimulus is given there. Now, these are all broad generalizations. Not only can you not always link the announcements to the actual price, but also because we obviously have a huge disruption in logistics channels here. So just because the Chinese do something doesn't mean there's increased global demand. Other than that, in being in touch with vaults and coin dealers and others, there obviously are some challenges on the coin market because the mints aren't producing, and so there's a shortage there. We do see and know people who have access to certain coins, at least. The refineries, the gold mints, I would say, are still shut down, several of them, and so there are some supply issues. But the vaults we talk to are operational and operating at very high capacity, but they do operate smoothly from the ones that at least we have talked to. Anyway, have a happy Friday. Have a great weekend. Be safe out there. Hope you're getting used to this quote unquote routine. Getting a routine is less stressful for everybody. And with that, have a great weekend.